Here is a number that should not exist. This week, Intel, the company Wall Street spent 2 years writing obituaries for, tried to sell $20 billion of new stock. Investors showed up with more than $100 billion of orders. 5 times more money than there were shares to buy for a company that 18 months ago was cutting 15,000 jobs, cancelling its dividend, and getting kicked out of the Dow Jones Industrial Average. Its replacement in the index, in a twist nobody at Intel enjoyed, was Nvidia. Today on The Current, how the most hated large-cap stock in America became the hottest trade of 2026, who actually made money on the way, and the parts of this comeback that are still a promise rather than a fact. To understand the demand this week, you have to remember the despair. In August 2024, Intel reported results so bad, the stock fell 26% in a single day. Its worst session since 1974. The dividend, paid since 1992, was suspended. 15,000 jobs were cut. The foundry division, Intel's bet on manufacturing chips for other companies, was burning billions of dollars a year with almost no outside customers. By November 2024, the Dow removed Intel from the index and handed its slot to Nvidia, which by then was worth more than 30 Intels. The stock finished 2024 down roughly 60%, the worst in the Dow. Analysts openly debated breaking the company up for parts. That is the corpse Wall Street just fought to buy a piece of. The turn started with the most unusual stock purchase in modern American history. In August 2025, the US government converted $8.9 billion of money already promised to Intel, mostly CHIPS Act grants plus a defense program, into actual shares. 433 million of them, at $20.47 each, a 9.9% stake in the company. Washington did not call it a bailout, and technically no new money moved. But the signal was unmistakable. The United States government had decided Intel was not allowed to fail because it is the only American company even attempting leading-edge chip manufacturing on American soil. Critics called it state capitalism. Investors heard something simpler. There is a floor under this stock now. Once the government set a floor, the private money followed within weeks. SoftBank put in $2 billion at about $23 a share. Then came the strangest check of all. Nvidia, the company that had taken Intel's crown, its Dow seat and most of its relevance, invested $5 billion at around $23 a share to co-develop chips together. Think about what that ecosystem was buying. Not Intel's products, which were still uncompetitive in AI accelerators. They were buying insurance, a stake in the only alternative to TSMC's island of Taiwan, and a claim on whatever the American government was clearly determined to keep alive. At under $24 a share, that insurance turned out to be the trade of the decade. Then something happened that almost nobody had modeled. The boom in AI agents quietly revived Intel's oldest business. Every AI agent runs on GPUs for the thinking, but the plumbing around it, the databases, the web servers, the orchestration, runs on ordinary CPUs, and agents generate staggering amounts of that ordinary work. By the first quarter of 2026, Intel's data center and AI revenue was growing 22% year-over-year to $5.1 billion, and management said orders were exceeding manufacturing capacity. In April 2026, Intel posted its best single day since 1987, up 24%. The company Wall Street had priced as roadkill was suddenly supply-constrained. The stock has roughly tripled this year, up more than 360% over 12 months. The comeback story has a second engine, the foundry. Intel's next-generation manufacturing process, called 14A, is aimed at mass production around 2028. And this year, it landed its first marquee customer, Tesla, for future chips. Then the President of the United States announced that Apple would make processors with Intel, a claim neither company has confirmed, which is exactly the kind of sentence that moves a stock whether or not it turns out to be true. This is the part of the rally built on the future tense. Signed one famous customer, rumored another. Revenue from 14A, not before 2028. Wall Street is currently paying for that future as if a good portion of it is already booked. Which brings us to this week's deal. On August 10th, Intel announced it would sell $15 billion of new stock. Demand was so heavy, over $100 billion in orders, that the deal was upsized to $20 billion. 210 million new shares at $95 each, closing August 12th. Here is the mechanic worth learning. Companies sell stock when it is expensive, because that is when each dollar raised costs the fewest shares. At $20, raising $20 billion would have diluted shareholders by a third. At $95, it costs less than 5%. Management is doing exactly what a rational owner does, converting a hot narrative into cold cash while the window is open. The buyers should ask themselves what the sellers know about windows. Now run the math on that government stake. 433 million shares bought at $20.47, $8.9 billion. At this week's offering price of $95, that stake is worth about $41 billion. That is a paper profit north of $30 billion, one of the most profitable single investments the US government has ever made. And it happened more or less by accident, through a grant conversion designed as industrial policy, not portfolio management. SoftBank's $2 billion has roughly quadrupled. Nvidia's $5 billion is worth about 4 times that. Every entity that bought the despair got rich. The people buying this week are paying $95 for what they paid $20 for. Zoom out to the week around this deal, because Intel was not an outlier. Supermicro guided next year's revenue to as much as $72 billion against a $52 billion consensus, and said it booked $60 billion in new orders. CoreWeave doubled its revenue and jumped nearly 20% in a day. Nebius, Lumentum, memory makers, power companies, everything touching AI infrastructure rallied. Seoul's Kospi index rose 4% in a session. A calm inflation report cleared the runway, and the S&P 500 and Nasdaq closed within a whisker of all-time highs. This is what it looks like when a market decides a boom is permanent. Not one hot stock, but $100 billion chasing every ticket on the same train. Now the other side of the ledger, because there always is one. Intel's new factories are being built substantially ahead of the customers who would fill them. Beyond Tesla, the marquee 14A names are rumors, and that revenue starts in 2028 at the earliest. The stock now prices a turnaround that has happened for 1 year, after 5 years of failed ones. And the market carrying it is historically narrow. The 10 biggest stocks are now about 35% of the entire S&P 500. At the peak of the dot-com bubble, that number was 25. Intel itself is the cautionary tale here. In 2000, it was one of those untouchable top stocks, and it took 2 decades and a government rescue to matter again. Concentration is not proof of a top, but it is the precondition for every bad one. Here is the takeaway. The Intel story is really 3 stories wearing 1 ticker. A genuine operating turnaround, measurable in revenue and orders. A government flaw that changed the risk math for everyone underneath it. And a narrative rally, the part priced in future tense that management just wisely converted into $20 billion of cash. The people who made fortunes bought when the government did, at 20, when the story was despair. The $100 billion that showed up this week is buying at 95 when the story is destiny. Same company, 5 times the price, and the difference is entirely a story. We covered the other side of this machine, the $500 billion being borrowed against the chips themselves, in our last episode of The Current. Watch that one next, because these 2 stories are secretly the same story. Subscribe, and we will keep following the money.